I also think that the apartment market there's some optimistic signs. Last week I was highlighting some numbers from Apartment List, and these numbers were painting a little bit more of a negative light on apartments. They were showing slightly increasing vacancies, and just it was and rent growth that was largely just the same as the year before. Now I don't think that that's going to change materially, but there are signs of clear improvement shown in articles from RealPage, and then we'll just really briefly cover this similar report from Yardi Matrix that says about the same thing in terms of actually the apartment market is improving. Demand is increasing. Supply is decreasing. Rent growth is expected to go up. Mm-hmm. And we're meeting this crisis with about as strong of an apartment market as we've had in several years. So that is that's the optimistic thing. And if you wanted to skip ahead and maybe you were skipping forward you could skip all the negative stuff and just focus on this right here there's some good news in the apartment market, and it is also worth mentioning. In the January to March quarter, this is the RealPage article. In the January to March quarter, the U.S. absorbed over 138 market rate apartment units, making the highest first quarter demand on record in the RealPage dataset, which goes back over 30 years. So again, to repeat this is the strongest quarter in 30 years in the apartment market when it comes to demand. That's amazing. And yes, we had a lot of supply, but that supply in this last quarter has actually gone down. Supply for the year was 576,000. That's the year ending in Q1 2025. For the year ending in Q4 2024, it was 589. So supply is going down, demand's going up. That's great. Demand in Q1 was 138,302, like we just noted. Supply was at 116,092. So here, let me scroll down to the graphic here. That probably illustrates it a little bit better. Supply was lower than demand. That's good for apartment operators. That means improvement. So there are signs on the whole that the national apartment market is coming into greater balance. Now, we've seen balance in the Midwest specifically for a long period of time. The Midwest, their annual rent growth is at 3.6 for the region. Northeast following a little bit lower at 3.3, but that's still great and still a lot more than the South, which is at negative 0.2, or the West, which is at positive 0.5%. Now, this is just the regional averages for those regions. Very strong rent growth in the Midwest. It's something that we will be talking about in a future report from the Gray Report, and something that we've really focused on and been talking about ad nauseum within Gray Capital discussions. Is how the Midwest has shown not only strong rent growth now, but just stability throughout the period of the past 5 years. While they were really building and perhaps overbuilding in the Sun Belt, in the Midwest, we just didn't see the amount of overbuilding, and that has resulted in more stable rent growth that is as close to the national or the historical average as you can get. And you can see in this graph too how the supply and demand difference from basically Q1 2022 to Q4 of 2024, there was more supply than there was demand. That was a negative, so that balance was negative, and it is only recently, maybe Q4 and Q1 of this year, where it's become positive, where we've actually started to make some progress when it comes to filling up these apartments and not making them more empty by building new ones. Another good data point is this. The regional representation among the market leaders for rent growth. So the apartment rent growth leaders for March 2025, and this is the year-over-year rent growth, are very well represented by Midwestern markets. Kansas City is at the top at 5% rent growth, followed closely by Chicago at 4.8. Then you got Pittsburgh, San Jose, but then Cincinnati at 3.9, Columbus at 3.7 rent growth, then Detroit, and we'll throw Milwaukee in there too. These are all in like the top 10 apartment rent growth leaders, very well represented amongst the Midwest, and I'm looking for something that's firmly in the South. San Jose, I'd say that's more of a Western market. And
no, that's definitely a Western market.
All right, good. Well, yeah. And I don't see a firmly. Now, is Richmond That's in Virginia. It's arguably the Sun Belt, but I'm not sure completely.
I mean, you can make the argument it's the South based on the sense that Virginia was in the
like that Mason-Dixon, which come on.
But I don't. You go through your list of southern cities. I don't think Richmond really comes to mind for a lot of people. But
but if you scroll down to scroll down to markets with the deepest rent cuts, then you see a lot more of these clearly stereotypical Sunbelt markets, led by Austin at 6.4%. That's negative 6.4% rent growth. It's kind of no surprise there. And Phoenix is negative 4.2, then Denver 4%, Atlanta, Jacksonville, San Antonio, Salt Lake City, Dallas, Raleigh, Orlando, and Nashville. Nashville, negative 1.5%. So that's your kind of range there. You're going from negative 6.4 to negative 1.5. Not any rent growth.
So a lot of these markets on this part with the deepest rent cuts, these are all kind of the markets that I was mentioning earlier. I'm curious to know where their current investors are and how they're feeling about the tariffs, in the sense that they're not going to have a whole lot of supply, if any, to compete with moving forward. Should these tariffs have the effect that we think that they're going to have, and should these tariffs stick around? Also, that's
a really good point. Are there going to be specific markets that feel the effects of these tariffs more strongly or more weakly? Will this make like the logistics and supply chains within America like more relevant when it comes to how cheap it is to build? Like that's going to be particularly interesting.
I mean, I want to say Indiana is one of the states that has like the highest amount of jobs in industries affected by these tariffs. That's
really okay.
Cause some heartburn. Or very well could. But I'm more so curious to look at these markets where like what is the true effect on new deliveries and construction? Kind of as we alluded to earlier, do we see some of these apartment complexes get halfway built and they don't have the money?
Yeah.
Could very well happen.
Which maybe leads to like a weird, like if supply construction is paused or delayed, does that mean that demand has more time to catch up to the oversupply in the Sunbelt markets? Is that what you're saying?
I would think so. I mean, if you, and even then, if you go on CoStar or whatever, you can see kind of projects that are planned and you just need to get shovels in the ground.
Maybe I'm not going to do
some of that supply that you thought you're going to have to compete with, you may very well not have to.
Yeah.
But also to touch on the supply here, because that truly is.
Yeah, let's scroll up to the supply.
And I know this argument has definitely been advocated for on this podcast and other real estate forums of it is supply and demand, not rent control or other measures that are going to push us forward on making housing more affordable.
Yeah.
If you take the largest markets in the Midwest, whether they lost population or gained population, none of them really had a massive run-up in new supply.
Yeah.
And there wasn't, I shouldn't say I'm not mistaken, all those markets, the big markets in the Midwest, they never hit double-digit numbers in terms of their percentage of inventory under construction.
Yeah, yeah.
The largest markets in the Sun Belt, I don't believe Dallas did. Dallas got pretty
that's
close.
Huge.
Dallas got, I want to say, like 9% of their inventory under construction.
But at one point, all of them were at
I can't say
yearly.
There's some that I didn't, but a lot of your big markets there. Phoenix definitely did. Nashville did. Austin did.
Yeah,
you're seeing it play out.
Yeah, yeah, and just a reminder: Austin, Phoenix. Those are the two markets with the deepest rent cuts. I think that's there are things that you can take from this, and it may be certain regions are going to perform better. Certain regions are in a better position currently, and I hate to say that we'll have to wait and see, because I think that there's enough data that we're parsing through right now where you can at least make a choice to not pursue some things, or to pursue things at a lower price than you would before. There was a quote in one of the articles here where like, oh yeah, well There, of course, there are some institutional investors that are looking for some opportunistic deals. I was like, all right, they're looking for their knight in shining armor, the kind of perfect deal. That's when I see dry powder slated for opportunistic deals, I'm like, well, they're waiting for the perfect deal that may not ever arrive. But they were saying that as a way to soften the blow that the average investor, the average CRE investor that's not institutional, is maybe less interested at this moment in time than others, and that was partly in the way of explaining why there is a little bit more debt financing, a little bit more funding that's coming from debt, whether it's preferred equity or private debt or.
I mean, I think it really depends on how you want to define your investor type. If you're looking at people they're really in the real estate space and they're familiar and they know what they're getting into, and a lot of their other avenues are investing are kind of on their list, kind of below in priority of real estate. Mm-hmm. No, I don't think any of those people are. I don't think they're going away, and I don't think they're less interested. I think there's a little bit of doom and gloom in the sense that a lot of these value add deals that, if you're an investor or a company that specializes in value add, I wouldn't say there's less interest, but today's definitely a gut punch.
Yeah.
Or this week is definitely a gut punch because you don't know what the future holds.
And I was saying this in 2025 is do you wonder if there's going to be a kind of race to sell before it gets even cheaper? So if there is any reason for a multifamily owner to sell, would it become a pervasive idea that oh man, people are fleeing for the exits. We might as well get our 20% price cut because a 30% price cut is just a week away. That's an open question that I've got, and the only thing that I have running on it is loan maturities.
I don't doubt that. I think it's going to be more so your properties where you're going to have to bring money to the table to do work on it. Your core plus deals, if you're in your core plus deals, where you're in markets where the fundamentals are strong. It's not to say that won't happen, mm-hmm. but if you don't have to put work into the property, your rents are still strong, and your financing is still in line. I can't really foresee a scenario where it's we really have to get rid of this.
Yeah.
Unless there's a lot of unforeseen stuff that goes on in the markets that we just don't that we don't know. If those prices do fall, I would tend to think that it would come not from the property and from the seller side, but from the buyer side.
Yeah. It's you got 3 buyers and they're all 10% or more below your asking price.
Well, how many people move back in the sense that our equity is just, it's a period we don't really understand. Mm-hmm. We really don't want to be deploying cash right now unless we can get really outsized returns on an asset that it's a home run that we wouldn't have been able to get otherwise. So, I guess in a roundabout way, you could see some sellers do that, but it really comes down to what the equity. I would say for your core and core plus assets, mm-hmm. it'll more so be driven by where the equity is than where the sellers are.
Yeah.
If truly that many people that have that situation on equity, you could probably see some sellers come around to that reality. Mm-hmm. But if you still have some people that they can ride in all cash. They could do all cash deals, or they have equity that's kind of really bought in and know that this is kind of the time to pounce and they're not going to have to do a value add program. I can't really see a scenario where it's really going to, you got to stop it from bottoming out.
Yeah, that's good.